Right, so let's continue with our discussion on the borrowing cost. And so far we've mentioned a couple of principles about borrowing cost. Number one, we said that we capitalize. What did we say was borrowing cost? Pause the video and say it loud to yourself. We said borrowing costs are interest and other expenses an entity incurred in the arrangement of borrowed funds, okay, in the arrangement of borrowing fund. So that is borrowing cost. And the standard says that all these things, the benchmark treatment is we write it off, we debit the statement of financial performance and credit a cash book or payables if it is still outstanding at the end of the year. However, there is an alternative treatment that if the fund borrowed was for the construction or acquisition of qualified assets, then the interest expense and other interest or other expense must be capitalized. Then we said that, okay, what then is a qualifying asset? A qualifying asset is simply an asset that takes substantial time for its completion. And we mentioned roads, so infrastructure facilities in general are qualifying assets. Then I said that there are a couple of principles that you must take care of. There are a couple of principles that you must consider when you are dealing with the issue about borrowing cost. And I mentioned that number one, we capitalize borrowing cost incurred in the construction or acquisition of a qualifying asset. That is the alternative principle. But then you don't just get up and capitalize. Borrowing cost to capitalize is the interest expense less the investment income. And you saw the two examples that we illustrated here under the non-haltage period and then the haltage period. And then the third thing is that the interest expense incurred during the haltage period is written off and not capitalized. So I illustrated and we said we use an illustration of 8 months haltage period in relation to that. Now, like I mentioned already, so you must understand the capitalization period, you must know the contract period or the construction period if you want. So the construction period must be known, and then the capitalization period must be known. They are not the same. The construction period is when they say they have started and when the asset becomes ready for use, or when substantially everything is finished with the asset. Now, you've got to be careful. The fact that something is finished and is not being used does not mean that we have to continue to capitalize the expenses of it. No. Once the thing is ready, quickly you go for it. Like for instance, recently there is an issue about government procuring ambulances, and the ambulances are packed, are waiting for emergency units in various hospitals, in the various constituencies to be well equipped before all the ambulances will be dispatched. The ambulances have been procured. They are ready. Other hospitals can take them. But they said that they must build the facilities for the other hospitals that are not well equipped as an emergency unit to be equipped before we dispatch the buses. Now, if we borrowed funds to acquire these buses, it's not ready for use. So the fact that it is not being used does not mean that you continue to apply the interest on it. No. Once it is procured and it is ready for use, if it is not being used now, that is not an issue. Or for instance, they construct an infrastructure building. It's a 5-story building. It has been constructed. They are done. And they are left with some minor deco aspects of the job. So substantially, all the job is done. And that minor job is not substantial. So for that reason, once the major job is done, we say that the contract has come to an end. So you must look at the construction period and the capitalization period. In the second scenario I gave you, the construction period was still 5 years, but I realized that our capitalization period was 5 years minus 8 months. And so we calculated the 8 months and we expensed that and deducted it from the total borrowing cost that we are supposed to pay. Now, when we are dealing with public sector organizations, one of the things that you must understand is that sometimes government borrows money and or a public sector entity borrows money and doesn't use it by itself, but give it out to another entity that is in its economic entity. So they are the controlling entity. They are the parent company and they have some subsidiary. So they borrow the money and they gave it to them. Now, how then do we treat it? The entity borrowing the fund, since it is not using the fund for its own purposes, then it cannot recognize anything in its book in relation to the interest. Because the one that is using it is the one that will be recognizing on the interest. If it is for qualifying assets, then it has to be capitalized in the books of the organization in relation to that. So when you talk about borrowing costs, there are a couple of things that I have as well in my slide. I've already spoken about them, but I just want to repeat them to you. Commencement of capitalization. So when do we start to capitalize the interest expense? That is the capitalization period. When does it start? Three things can be an indication. One, outlays for the assets are being incurred. Okay, so we are giving the money for them to start the job so we can start capitalizing. Two, borrowing costs are being incurred. We are borrowed some money for the outlay that we have made so we can start capitalizing. Three, activities that are necessary to prepare the assets for its intended use or sale are in progress. So whatever it is that is necessary for the assets to be ready for use, necessary for the assets to be ready for sale, it's still in progress. They are still doing it. They are still working on the road. They are still constructing. So if they halt, then there is no activity happening. Then they have to what? Write it off in the year under discussion. But like I said, there are a couple of exceptions. There are sometimes there is no physical progress on the activities, but that doesn't mean that we will suspend the capitalization. Let me take that again. There are sometimes there is no physical, there is a physical haltage of the project or of the construction of the assets, but that doesn't mean we will suspend the capitalization, because sometimes the stoppage is necessary for the construction of the assets. Other times, the stoppage is necessary for certification, for the obtaining of permits, for the settling of issues. So if some administrative activities have to be completed before the project physically continues, then even if it is physically stopped, because the administrative activities are ongoing, we will still continue to capitalize the expenses incurred in that period. If not, then we can write it off in the year under discussion. So that is something that is critical, something that is important, and something that you must understand in relation to that. Then another thing is the amount of borrowing costs capitalized during a period should not exceed the amount of borrowing costs incurred during the period. It's reasonable, right? It's reasonable. Like the 5 year scenario I gave, you incurred borrowing costs of say 400 and whatever. How much was it? They were somewhere. I've claimed my slide. So let's say that the total expenses for the 5 years was say 192.5 million Ghana cedis. This is the total expense. Then when you are recognizing it in the book, you go and recognize 205.32 in your books. I mean, it doesn't work. How can you incur an expenses of 192.5 and recognize 205.32? So the amount of borrowing costs capitalized during the period should not exceed the amount of borrowing costs incurred during the period. That is very, very important. So these are the ideas, these are the concepts, these are the principles that you must understand under IPSAS 5. So remember, another thing that you must take into consideration, this one nearly escaped me. Thank God I remembered, because I was not looking at my slide. So it just dawned on me. Now there are times when the scenario I gave you earlier, you realize that I told you the government issued loan notes. Okay? So they obtained the fund from just one source. But there are some times when a company, the government is undertaking, a public entity is undertaking a project, it may not be able to obtain the required fund from a single source. So let's say for our 250 million Ghana cedis loan facility, the government issued loan notes and it was undersubscribed. So from the loan notes at 18.5%, the government was able to raise out of the 250 million only 135 million Ghana cedis. Okay? Then the government says, I still cannot construct this road with just 135 million. So the government goes to financial institutions locally or in the domestic country and goes to, so this is from their loan notes. So it goes to the banks domestically, and all the banks said they were broke. They were going to give the government money. So, but one bank was able to give the government some 50 million Ghana cedis, and that 50 million Ghana cedis was given at an interest rate of say 17.5%. I want you to follow me carefully. Now, are we still up to 250? We are not up to 250. So that will be 185 minus 250. So remaining 65 million Ghana cedis. So for the 65 million Ghana cedis, the government went to the World Bank to borrow the 65 million Ghana cedis, and the World Bank gave it to the government at somewhere around 12.5%. So the question then is, we now have our $250 million. Okay? We now have the $250 million. But as you can see, this $250 million was borrowed from three various sources. Now, if we want to determine the interest expenses, thereby determining the borrowing cost, and to determine how much to capitalize, the question is, which interest rate do we use? Do we use the loan note interest rate? Do we use the interest rate from the domestic bank, or we use the IMF rate? What do we do? The standard says that under this circumstance, we calculate what is called the weighted average cost of capital. Okay? The weighted average interest rate. Okay? The weighted average interest rate or the weighted average cost of capital. So how do we go about that? How do we go about that? So the way we do the calculation is calculate the weighted average interest rate is to bring the loan sources and look at their percentage of the total loan and use that to multiply their interest rates respectively, and we get an average. So this is what I mean. So loan, we're going to have a percentage, we're going to have interest rate, then we're going to have the average here. So look at what I mean. From the loan notes, loan notes, what is the percentage of the total 250%? So that was 135 divided by 250 times 100, and that's 54%. Okay, that's 54%. The interest rate is 18.5%. I'll come back to the average in a moment. We will do the same thing for the bank, domestic. It is 50 million. That would be like 25%. So 50 over 250. Let me just confirm. Well, that's 20%, right? That's 20%. And the interest rate is 17.5%. Then the last one is the one the government got from the World Bank, and that's 65. So 65 over 250 times 100, that will be 26%. And the interest rate there is 12.5%. Are we following? Are you following the concept? So now, how do we get the average? We multiply. So 54 times 18.5 divided by 100. That will give us 9.99% for the average. 20 times 17.5 divided by 100. 3.5%. 26 times 12.5 divided by 100. That's 3.25%. Then we add these three averages. So 3.25% plus 3.5 plus 9.99. So we have 16.74%. This becomes the weighted average interest rate. I hope you got this. I hope you got this very well. So if the government borrows the money from different sources, we cannot use one interest rate of one source for the entire amount as our interest rate in the calculation of our interest expense on the loan. Rather, we need to calculate the weighted average interest rate. How do we do that? We bring each of the loans and find out the percentage of that loan from the total respectively, and we bring their interest rate respectively, then we multiply. That gives us the average interest rate, and we add all the average, and that gives us the weighted average interest rate. So now, if we want to calculate the interest expenses or the borrowing cost on this 250 million Ghana cedis, we will use 16.74. So the borrowing cost will be equal to 250 million times 16.74%. And that will give us the annual borrowing cost. So 250 by 16.74, and that's going to be, I got it wrong, 250 by 0.1674, that's 41.85 million Ghana cedis. So if this loan was just a normal loan for a normal government activity, then we write it off by debiting the statement of financial performance and crediting cash if we have paid. If we have not paid, we credit payables as outstanding interest. But if it was a loan for the construction of a project, of a hospital, for the acquisition of an asset, then we have to capitalize these expenses. Now remember, this is just 1 year. So the number of years, that is the capitalization period, we use it to multiply, then we'll get a total borrowing cost. So this is what you have to understand when we talk about borrowing cost in relation to funds or getting the money from various sources. So the last but not the least is the disclosure requirements for borrowing cost. The standard requires that the financial statement should disclose A, the accounting policy adopted for borrowing cost. Are we writing it off like the benchmark treatment, or we are capitalizing it and amortizing it over the economic useful life? Remember, there is something here that I didn't mention. So now, that asset that we've constructed that is now worth 414.42, if we are depreciating it, we don't depreciate it using the cost, but we depreciate it using the initial cost. And we will deal with these things later on when we are dealing with IPSAS 17, property, plant, and equipment. And when we get there, and I'm making reference to this, make sure you don't scream out, because we have already done it in relation to that. 2, or B, the amount of borrowing costs capitalized during the period. So we must also disclose the amount of borrowing costs capitalized during the period. So if the borrowing cost is, say, 90 million, and we have capitalized 75 million, it means that there is 15 million that hasn't been capitalized. So we must distinguish and categorize that in the books for the entity. And the capitalization rate used to determine the amount of borrowing costs eligible for of capitalization. When it was necessary to apply a capitalization rate to funds borrowed generally. So the capitalization rate, like this. Like this. So if we are borrowing the funds from 3 sources, then the weighted average rate, that becomes the capitalization rate. We must disclose that in our books along with what? These rates. But if it is just from one source, then that one source becomes the same as the capitalization rate in relation to that. So this is what you have to understand about IPSAS 5, borrowing cost, and this is the same as IAS 23. The same ideas, the same concepts, but remember the terminologies and the illustration that we are using are what is different in relation to that. So that is it about that. And if you have any questions, you know what to do. You write them down, and during our one-on-one session, you ask me with that, or when you come to for lectures also, you can ask me any questions that you have in relation to IPSAS 5 borrowing costs. I'll see you in the next video as we continue and go to another key standard for the subject, and that is IPSAS 9, revenue from exchange transaction. This is similar to IAS 18 revenue. So I'll see you in the next video.